Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to all the Trade Day team for today's TGI. Thank God it's Friday, the 26th of September, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. We're going to go for our usual regular run through here today. I'm going to take a look at the calendar, what we've had, what we've got coming up. Take a look at some articles from the major news wires. What are those macroeconomic, fundamental, geopolitical events that are shaping financial markets right here, right now? And then we'll dip into some of the charts and take a look at how they're shaping up going into today. Okay, so looking back before we look forward, yesterday's numbers, GDP. Now, I spoke about this earlier on this week, and I think the back end of last week, about good data. And by good data, I mean economy positive data, positive economy data, being bad for markets and the current climate we're in, the current position we're in. So, what do I mean by that? Yesterday was a perfect example of GDP data in here. Better, significantly better than expected. Also, the durable goods orders. So, durable goods orders were expected down 0.3, came in up 2.9. Preliminary goods orders for August. And then the GDP number, quarter on quarter back for Q2, came in at 3.8, with expectation of 3.3. GDP really moves markets, but that's a significant difference to the expectation, 3.8 versus 3.3. Okay, and what it means is that the economy was back in. So remember, this is looking back to Q2. But the economy was doing better than the market had anticipated, or the market has thought that it had done, and so. And then translating that into then what happens in the market, rather than, okay, good economy, good for stocks, right? The economy is strong, economy is growing, that should be good for stocks. The stocks actually went lower, and they've been going lower this week on often positive data because of concerns that now we're in a mode. The market is in the mode, and as priced in rate cuts from the Fed. We've had the first rate cut from the Fed. The market was pricing in. The Fed basically told us they're going to cut another 2 times this year, in October and December, depending on the data. But the data's coming in better. So does that mean that the Fed are going to move away from this more dovish position, dovish being more willing to cut rates, and more to a more hawkish position? Not more hawkish doesn't mean they're going to increase rates, but what it means is they're less likely to cut rates. So it's like de facto, in fact, less dovish equals effectively more hawkish. So not cutting rates by as much as we expect is effectively similar to increasing rates, right? Because the market is expecting rates to be lower, and they're not going to be maybe as low as we thought. And the market is more now pricing in the rate cuts and the anticipation of the rate cuts, which is what corporates want to stimulate the economy. And also for them, it's positive. Remember, lower interest rates are positive for corporates. So lower interest for both, better for corporates, and also more stimulating for the economy. So the market's already pricing that in. So when we get good data, which might mean the Fed are less accommodative, less dovish, less likely to cut rates by as much as we previously thought, then that positive, good data again, positive for the economy, ends up actually seeing stocks go down. So it's kind of counterintuitive, but that's the way the market is thinking. That's the way the market is pricing in. Now, what you really want is the data to be okay. It could be a little bit better, yeah, or it could be a little bit worse. In fact, a little bit worse is actually even better, because it means that the Fed are more likely to cut rates at least as much as we say, or more. So the market would actually prefer the data to be slightly, what we say, softer, worse than expected. So if GDP had come in at 3.3 bang in line, or maybe even 3.2, the market would have been, oh, the Fed are definitely going to cut rates. They're going to be more dovish. We like that. And the market would have gone up. So I think what we're looking for is data to be around where we expected. And when the data is a lot better than we expected, it's actually going to be negative for stocks and stock indices. Okay. So just wanted to explain that, right? And sometimes when you go into the Fed starting to be there's anticipation of the Fed after they've started to make a move and they go either on a hiking cycle, an increasing cycle, or in a cutting cycle, you can get this kind of these moves which are counterintuitive to what you would normally expect. Okay, so I just want to explain that. And this article is talking about that. We spoke about this last week and again early this week. U.S. economy grows at fastest pace in nearly 2 years on consumer spending. So this is like the positive data in here, actually meaning then that the fastest is growing in 2 years, but stocks were down on the back of concerns about the Fed not being as dovish, and I've got some more articles talking about that as well. So I'm looking in today. All eyes are going to be on this. It's now in 55 minutes time. Core PCE data. This is the Fed's preferred measure of inflation. Expectation on the month-on-month at 0.2 and the year-on-year 2.9. Now, we really want to see, if you're a bull and you want the stocks to go, if you want stocks to go up, what we really want this to see is this to actually be lower than expected. So then it opens the door to the Fed being more dovish, okay, in here. So we want it to see if this number is high. I think stocks could really get hit, because then it's like, well, now the economy is strong and inflation's high. If the GDP number yesterday was strong and the inflation's ticking up, then the Fed are less likely to be more dovish, less likely to be cutting rates. And then that will be seen as negative for stocks. Okay, so I think this is going to be important data that we get through today. Also, don't forget, we do so. This is often forgotten. It comes as the later piece of data, always on a Friday. Michigan consumer sentiment and expectations. Watching out for that for 10 o'clock Eastern. But really, all eyes today on that core PCE data coming out, month-on-month and year-on-year data now in 54 minutes. And then here, if we go to the morning briefing, Americas, alarm sound on AI spending boom. So this comes from David Einhorn, a warning on the vast amounts of capital pouring into AI infrastructure. Is it sustainable in here? There's not a huge amount. Trump announced some fresh tariffs on pharmaceuticals yesterday as well in here, which weighed a little bit on markets and weighed on Asian stocks in here overnight. Fed's tough job gets harder. So this is from Reuters, morning bid. Fed's tough job get harder. Why? Because that's strong data. Look, the US Federal Reserve was made a bit harder yesterday. Firstly was the news that second quarter GDP was revised up to 3.8, fastest annualized growth since that here. And then also Trump adding in new tariffs, right? So adding in those extra tariffs in here on branded drugs in here, and heavy duty trucks in here, potentially going to be putting in inflationary pressure. So inflation up and the economy go stronger, potentially inflation up because of higher tariffs. And then what does that do? Then it means the Fed are probably going to, again, going back to this point, the Fed are going to be less likely to be more dovish, less likely to cut more aggressively on interest rates. So de facto, more hawkish, and more hawkish then seem negative for stocks. But European stocks actually doing okay today. European stocks lead as Trump's tariffs knock Asia. So those tariffs potentially going to knock Asia. And then Fed rate cuts bets recede. We'll come to that when we look at the FedWatch tool and see it directly on that FedWatch tool. US futures wavering this morning and overnight as traders await fresh rate cut clues. That's going to be from that inflation data today. Wall Street futures mixed, investors brace for inflation data. That's exactly that data. And then looking ahead to next week, okay, Wall Street investors look to the jobs data. So next Friday, we'll be counting down to the the September jobs report in here that's released on the first Friday of October. So next Friday, we're going to be watching for that. If we go our tour of global markets, Asian stocks down in here because of those tariffs announced by Trump. Nearly 9/10 in here on the Nikkei down and over 1.35%, over 1% lower on the Hang Seng. As we said, the net beneficiaries have been actually European stocks, which are actually doing better across the board in here, between a quarter and a third of % higher across the UK FTSE, German DAX and French CAC this morning, and turning our attention to, as we said, US stocks in here, just sitting, marking time, having dipped again yesterday. Remember, we're down Tuesday, Wednesday, Thursday. Not big sell-offs, but nevertheless, market moving notably lower over the last 3 sessions in here, but then overnight just sitting here pretty much unchanged overnight. So this is the important chart in here. You can see, remember, this has been sat above 90% since the last Fed rate cut. This is for the end of October, the 29th meeting in here. This now sitting at 85%. This has been slowly receding. For the not huge receding, it's still pretty much nailed on that we're going to cut rates again. But look at this in here for the year end. Now only a 62% chance that we get a second rate cut by year end. This was priced up above 75, 80, I think. So we were pretty much nailed on. We're going to get 2 rate cuts. Now we're getting closer to 50-50, right? 62% chance we're only at 1 rate cut at the end of the year now. So this is what it means when the Fed, this positive data, meaning the Fed are going to be less likely to cut rates, which is being seen as negative for stocks, and yields continue to climb higher. So again, this is reflecting that as well. Yields going higher, which means prices, that's the 10-year yield, means prices going lower. Again, 30 years selling off, 10 years selling off, 5-year plunge yesterday, and the 2-year as well, significantly lower. This is on the back of that GDP data. So this is lower prices, higher yields at the short end, particularly at the short end. 2s and 5s got hit the worst, the shorter end of the curve. Why is that? The shorter end of the curve more sensitive to what the Fed are doing, the longer end of the curve more sensitive to the economy. So markets concerned more that the Fed are going to be not as dovish, as we've already said. So there's the sell-off we've seen. Now we did get a sell-off and a rebound yesterday, and we're hanging on to a bullish outlook in here. We haven't really taken out the really notable supports. They're down here at 66.11 on the S&P, and down at 24.242 on the Nasdaq. Those are the big levels below. If we take out those, then it turns a lot more bearish. Looking for those to hold, looking for a rebound today, but it's all going to be on that PCE data, which we now get in 49 minutes. So all eyes on that going into today. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'm going to wish you all a great weekend too. And we'll be back with you with another Bull versus Bear webinar on Monday. Take care. Bye.